Welcome to the 2022 Wealth Stewards Real Estate Summit. It is Wednesday, March 23rd, 2022. I am Bob Simpson, Vice President, Portfolio Strategy, and I'll be your host this evening. I'm joined by Paul Tyers, Managing Director and Portfolio Manager. Now, real estate is an amazing asset class that combines the ability to generate income while benefiting from growth by investing in hard assets. With all that's happening in the world today, I believe that there's never been a better time to bring together our diversified panel of specialists. Now, before we begin tonight's program, it is set up to leave time for questions at the end. If you have those, they will be answered by our panelists. Now, please use the Q&A button on your Zoom control panel to post any questions that you might have at any time. Now, we will try to address as many as possible. Please don't be intimidated. There are no bad questions. Secondly, a reminder to our panelists that our audience is not made up of financial professionals. So let's try to keep industry jargon down to a minimum and keep it simple so that our audience will enjoy listening and learning this evening. Now, thanks for joining us this evening. Our first guest this evening is Dave Steele from Western Wealth Capital. Dave is co-founder and general partner at Western Wealth Capital. He is an entrepreneurial executive who's offered leading-edge investment opportunities to thousands of individual investors in both Canada and the United States. Western Wealth invests in multifamily residences in some of the fastest growing job markets in North America and benefit from the turnkey processes to upgrade the properties, which will allow investors to participate in a proven wealth generation system. Dave is an extremely knowledgeable and experienced guy, yet very engaging as a speaker, and we're glad to have him here tonight. So we're going to start things off with Dave. And Dave, you and I met in a hotel in downtown Toronto in late 2017, and you were explaining to me about how you were buying multifamily residential properties in hot job markets in Arizona and Texas and applying your 12-step, I'm highlighting that 12-step process to upgrade your properties and to improve the value to generate above average returns for investors. Now, since then, I've seen your process in action in both Dallas and Phoenix on the discovery tours, and I know that you've had significant upgrades to your program. So can you just spend a few minutes with us, Dave, and welcome, but spend a few minutes just explain the concept of Western Wealth Capital.
Well, thanks, Bob. Appreciate being on the call, and thank you to you and Paul for inviting me. The 12-step, when we met, I think we'd acquired our 20th property at that time. As of today, we've acquired about 120 multifamily properties down in the US, Texas, Arizona, Atlanta, Georgia, Las Vegas, and Tucson. So we really kind of focus on high growth markets. And the 12-step process was we would go and buy a 1980s vintage building, and we would renovate all the suites and fix up the clubhouse. So we had 12 things that we did. And over time, that 12-step became 52-step. And as of last week, it's now an 82-step process. So we literally do the same 82 things to each building. We change out the pool furniture. We reline the parking lot. We've got a very systematic approach that's worked very, very well, taking these old buildings and making them kind of brand new. Transform them, if you will. I mean, I'm probably one of the few people in the world that would walk into an apartment that has shag carpet and a turquoise toilet and actually be excited because I know how much money I can make by turning it into a modern apartment that people want to rent nowadays.
Yeah, so Dave, just talk to us a bit about, what do you do? Like you've talked about the fixing the parking lots and doing the landscaping and that sort of thing. But how do you really generate return for investors when you buy one of these? Or are you just buying the building and hoping that the value of the building goes up, or you're doing a value add program to increase?
Yeah, it's really systematic, as you know, from coming on the discovery tour and seeing it. But we go into each suite, we spend about $6,250 per suite. We put in new stainless steel appliances, new hardwood floor, new bathroom fixtures, new light fixtures. And what's kind of unique is we renovate every suite identically. So if you came to one of our properties in Atlanta, one of them in Dallas, one of them in Phoenix, you'd see virtually the same finishes in that suite. So we've completely standardized the process. And, you know, it's a very cool mathematical formula, because if I have a classic unit that's unrenovated and I renovate it, I can get about $150 more in rent on that unit. Well, people say, well, geez, Dave, what's $150? It doesn't seem to make that big a deal. Well, $150 is $1,800 a year. Real estate trades at a cap rate. So even at a 5 cap, and today the market's trading close to a 4 cap, but even at a 5 cap, that means that every time I renovate a suite, my building goes up, that unit goes up by $36,000. So if I can do 10 a month, that means systematically every single month, I can increase the value of that building by $360,000. I can increase it by about $4 million every year just renovating the suite. I do the same thing by adding washer dryers. We do fenced in backyards. The fenced in backyards get us $125. We put in parcel post machines. They get us another $10 a month. So we have about a half a dozen things that we do to the building that can very programmatically drive the NOI of the building up. And it's obviously resulted in some fantastic returns for our investors.
Yeah, so every dollar you spend increases the value of the building by $20. That's the math on
it. By $200. Every dollar of rent increase has a mathematical formula where you get a 200 times return on that dollar in terms of a return. So you know, we don't randomly spend money. We go and spend the money on the places that we know are going to result in an increased rental amount. And, you know, one of the big drivers in the market is the US is way behind, much like Ontario and BC, is way behind in the construction of new housing. And the pandemic certainly hasn't helped. You can't get trades, there's supply chain issues. So people are moving to these cities in droves, and there just isn't rental accommodation. The United States, Texas and Arizona is, you know, home of the free and the brave. So you've got a huge increase in rents. There's no rent controls. We don't have any of the rent controls we have in Canada. So, you know, we're able to, you know, very rapidly improve the buildings and then increase the rental rates.
Yeah, so that's how you, not unmute, that's how you increase the value of the building. And then, but we're also in an environment where, you know, we did a webinar back in March called Outlook 2022, and we had a demographer on, and he was talking about 88 million millennials that are in the US right now that all need a place to live. So you've got too many people chasing not enough apartments. So overall, as an asset class, it's something good. Now, in the introduction, Dave, I used the phrase wealth generation system. Can you just touch on that a little bit? Is it, you know, in most things you buy something and then at the end you get your money back and hopefully it's worth more than you put it in? Can you just explain how you work with investors to generate wealth?
Yeah, so we have about 2,500 individual high net worth investors. We do about a dozen properties a year. So we launch one property every month. So individual investors are able to invest in each building. So a typical building for us we would raise $15 or $20 million. So individual investors come in, and depending on how much they want to invest, they might put $25,000 into a per deal. Some people put in $500,000 per deal. So it's quite dependent on each person's individual situation. But what people seem to really like about it is it's very predictable, it's programmatic, and it's highly repeatable. So of the 120 properties that we've acquired, we've had 52 of them go through the full cycle. And the full cycle is we buy them, we renovate them, we fix them up. And then at the end of approximately 36 months, we sell the buildings. So for those 52 that have gone through the full cycle, we've held them for an average of 30 months, and the investors have had an average annual return on their money of 30% per year. Okay, so needless to say, as you know from a number of the Wealth Stewards clients that have participated, you know, we have a very, very happy investor base. the two stinkers, if you will, the two that haven't worked out, that are the lowest, both generated about 11% per annum. So I said to my stockbroker, gosh, I wish I was calling you complaining about my worst stocks being up only 11% a year. So, we've been very fortunate. And again, it's about programmatically going through, and it's a very systematic approach to what we do.
Now, Dave, we have about 5 minutes left. Time flies when we do these things, but talk about a couple of the markets. Talk about Phoenix and Dallas and what makes these markets so attractive for investors in multi-residential properties.
Yeah, I mean, it's, our focus is we look to the markets where there's the top jobs being created, because where the jobs are being created is where the people are moving. And, if you follow the stats, people are leaving California in particular in droves. They're moving to Texas, they're moving to Arizona, and they're moving there because there's jobs. There's Intel hiring people. Intel's spending $20 billion on a chip facility, right on the heels of that announcement. And that facility, by the way, is in about the second inning of construction. Right on the heels of that, Taiwan Semiconductor announced they're spending another $20 billion building a facility. So there's just massive jobs being created by Apple and Intel and Google and Amazon and these big companies. So the people are moving there to get the jobs, and they're all showing up there going, we need housing and we need rental accommodation. And, as I said, there should be a lot more housing being built, but there's just not the capacity in the system to do it. So in our view, it's a bit of a race to buy these buildings and renovate them, because the people that are moving there to work for Amazon and Intel and Google, they don't want to rent these buildings in their classic form. They don't want to rent the $900 a month one bedroom that's unrenovated, but they're thrilled to rent the $1,200 fully renovated suite where the pool's been fixed up and the new gym has been added and the clubhouse has been enhanced and the whole community's been transformed. So it's quite interesting, because if I took you back 30 years or 35 years ago in Ontario and the rest of Canada, I could drive you around to all these buildings that existed where this business model existed. And today, they've all been, that business model doesn't exist, or it exists on a much smaller scale. All the buildings have sort of been picked over and renovated and fixed up. But in these markets, there's still a really good opportunity to take advantage of improving the rental stock and making good, affordable housing in safe communities where people want to live.
Now, Dave, every time you release a new opportunity, you send us a detailed report. It says how many in this building we're going to put in X number of washers and dryers. We're going to do this many upgrades. We're going to put in so many fenced yards. And you actually give us the math as to what we should expect over a 3 to 5 year period, right? Now, you talked about 20, 30% returns on sold properties already. Normally, where do you come in? Like, what setting expectations for people? What could an investor expect?
Yeah, I mean, that's a great return. Most of our projects show a projected return 16, 17, 18%. And really the simple math is, if I can get a $300 rental increase per unit over a 4-year period, 5-year period, I can make you 100% on your money. Right? So I can get you, if I can do it over 5 years, I can make you that kind of return. Now, if I can renovate the suites faster and get more washer dryers and move the rents quicker, and I can do it over 4 years, I'm still going to get you that same 100% return. Now I'm going to do it over 4 years, or I'm going to do it over 3 years. So where we've really focused on it as a company, and we've really improved the system, is getting it so that we can do it much faster, because we know what the return looks like. We can show you. I mean, a lot of people call after they see our executive summaries and they go, geez, Dave, this looks exactly like the last one you showed me, and the one before and the one before, because it's your same boring system. And I go, yes, it is. We're not rocket science. We're not putting people on the moon. We're doing the same programmatic thing. And our goal is we just do it faster so we can get that return in a shorter period of time.
Right. So, David, earlier I mentioned that I've attended 2 of your discovery tours. Now, on April 30th, you're doing a Canadian investor tour in Dallas, Texas. So other than assuming that the weather's going to be nicer in Dallas than it is here up in the Great White North, why should people who either have invested in properties with Western Wealth or are interested, why should they attend this discovery tour?
I think it's like watching one of those home decorating shows where at the end, you can't believe how they finished that house or finished that suite. People come on the tours because what we're trying to do is transparently show people here's a before, a during, and an after process. And literally when the bus gets off at a property that we're looking at buying, we hear comments like, I'd never live here. My God, this leasing office is terrible. I wouldn't sit on the pool furniture around the pool. And then we take them to one of the completed properties and the light bulb goes on and people go, wow, I just totally get how the goal is to transform this community. And I mean, you've had the good fortune of seeing it live and seeing how it works. And so, I have a lot of clients that come and they bring their kids because at the end of the day, they want them to sort of understand another complexity to investing in real estate. And, a lot of what we do, we've just taken the whole renovation process and the whole transforming a community just to a larger scale. And so it's not only both interesting, I think, but it's just a really good way to get all your questions answered. You get to talk to the development team, the construction team, the property management team, other investors that have invested. And for us, it's about getting people with a comfort level, because most of our business comes from clients who've invested and refer other people. So
anyway, so Dave, thanks very much. Just for the sake of time, we're going to move on over to you, Paul Tyers.
Thanks, Dave. And I want to introduce Kent Willmore. Kent, there he is. Yeah. Hello. Thank you for coming this evening. And a quick introduction. Kent is the president of AGinvest. He has over 30 years experience in the agricultural field. To use an old farm joke, for many years, he's been outstanding in his field. He grew up on a family farm. He's been buying and operating farm for his own account since 2001. AGinvest invests in Ontario farmland, a limited yet valuable resource that offers farmers some of the best soil and growing opportunity in the world, growing conditions in the world. So thanks for joining our roundtable, Kent. And my first question is, you're a farmer, been a farmer your whole life. What led you to start a business to help investors participate in this unique and valuable resource?
Yeah, thanks both Bob and Paul for having me. And boy, I'm excited about David's presentation. That was pretty impressive. But yeah, I'll just introduce myself. So yeah, I grew up on a family farm in Ontario, and I learned the farming lifestyle when I was very young, and I really enjoyed it. In 1999, I started to buy, optimize, and operate my own portfolio of farmland. And my capital partner at the time was just using the banks like most farmers do. And I really started to see my personal net worth improve because I was buying and operating farmland. But what happened was, like with most farmers in the country, the bank will only lend so much because they lend on both cash flow and equity, right? So eventually it came time when the bank said, we're not going to lend you any more money. And I said, but there are so many opportunities out there. There's just I just saw so many opportunities, and that's sort of when it triggered. I'm going to start a company called AGinvest, and AGinvest was developed really to stand right in the middle between other people who wanted to invest in farmland as an asset to invest in, and farm families, because I like to say they speak completely different languages, farm families and investors, and AGinvest is a company that kind of stands in the middle and does the translating.
Well, very good. And I know that I understand you grew up in the Chatham area, and your focus is primarily on properties in southwestern Ontario. What makes this region so special?
Well, we've actually expanded, and we invest in all the farming regions of Ontario, which, by the way, is a very small portion of the province of Ontario. But Ontario is extremely special for a lot of reasons. One, glacial deposits deposited fantastic soils throughout the region. Well, probably the most impressive factor about the province of Ontario is our consistent rainfall. And there's a lot of people and institutions that have invested in farmland around the world. And without water, you just, it doesn't matter how good the soil or the climate is, you have to have water. Like you can have all the heat and the best soil with no water. It's just like humans. If we have no water, we're in trouble. So Ontario has a consistent rainfall aspect to it that makes it very safe, a safe place to invest. We have over 200 frost-free days because we're protected by the Great Lakes. We kind of have a barrier around us. We're actually benefiting from climate change. There's a lot of talk about climate change. Ontario is getting warmer and wetter because of climate change. Our logistics are fantastic with our 400 series highways. We're connected to the world through our Great Lakes St. Lawrence Seaway system that's right there. We're a one-day truck drive from 250 million people. So everything we can produce is quickly has access to people. We're surrounded by the largest body of fresh water in the world. I mean, I could just go on and on. Ontario is just it's a wonderful place to have farmland for sure.
And I recall on the tour that we went on, Kent, you were sort of drawing a parallel to some of the big farming areas in the US where they're reliant on aquifers that aren't, that are sort of drying up. Just going and Bob and I went on a tour last fall of several properties. At the time, and not being a farm kid, I was impressed with the pumpkins, soybeans, squash, etc., in which seemed to be very large farms. But how has farming changed over the past 10 years? And where do you see it evolving to over the next 10 years?
Yeah, so I'll kind of break it down into two parts of that question. But ag technology, just so everyone knows, ag technology, agricultural and food technology receives an incredible amount of R&D spending money, research and development. Second only to life sciences on the planet. So a ton of money goes into our food production. And food security is a priority for most nations. And we have an incredible task ahead of us to feed 10 billion people by the year 2050. And over the past 10 years, I would say that the real focus has been on productivity gains. So farmers, producing more food per acre and doing so at a cheaper cost. That's been really the focus, and it's been going quite well. We have been producing more per acre and doing it at a lesser cost. But access to that technology is expensive for farmers. So when you look ahead, I do see that we're going to continue with that plan of producing more produce on every acre of land because we have no choice, because we cannot make more land. In fact, we're losing millions of acres per year on this planet just through population growth. And humans put cities where there's great land and great water, but as those cities grow, they gobble up all that great land. So we have to produce more on less, and that's going to involve having capital partnerships with companies like AGinvest, because you have to be larger as a farmer nowadays to access that technology and make the economics make sense. Like a new combine, you can spend $1.6 million on one combine. So imagine trying to do that in a little tiny farm like we used to have 50 years ago. You just can't. So farming operations now are 20, 30, $100 million for one farming operation. So you need to have capital partners involved. And then the other thing I would say, looking ahead 10 years, is going to be a real big focus on sustainable practices as they relate to farming and to soil health, and to really protecting the soil and capturing carbon from the atmosphere is a great opportunity we have with farmland. It's going to be a new revenue source for farmland owners, is carbon credits and capturing carbon and storing it in the soil. So there's definitely exciting times ahead, and that increased every time we increase the productivity from technology, it accrues to the value of the land. And that's what the investors own, is the actual land. Very
interesting. So can you just expand a little bit, talk for a minute or two about the actual investing in farmland? You alluded to that prices go up. Why is it a good long-term investment? Well, first of all, has it been a good long-term investment as you look backwards? And why do you believe it's going to be a good long-term investment looking forward?
Yeah, and that's really the basis every time someone asks about returns and what we think about the future. I mean, it's really easy just to look back at the consistency of the farmland returns over the years. And over 75-year track record in Ontario, the average appreciation of farmland is a little over 8%. And that's a long track record at that number. And so we see, the demand for farmland moving forward. We see that trend is going to continue. We're comfortable, stating that fact. And farmers generally, if you were to paint them all with one brush, I would say farmers generally are cash poor and very, very asset rich. And we're in an environment of inflation right now, and owning cash is actually pretty expensive. If you understand, if you're sitting on cash, you're actually not doing so well. So we're kind of falling into this. If you own this asset, you're in a pretty good shape. And farmland, by the way, has outperformed all their asset classes during times of inflation. So we do see it as a fantastic investment moving ahead, and it really should be thought of as you don't get rich quick owning farmland. It's a stay rich plan, and that's why there's a lot of wealthy individuals and institutional investors looking at farmland. It's a stay rich plan. It's not cryptocurrency, you know what I mean? And so it's exciting for us looking ahead if you think of it from that perspective.
Yeah, thank you very much. I mean, I was quite surprised, not having previously looked back at the growth of farmland up to this point in time. And then that point about inflation, I think we're hearing a lot about that in the news these days. So that's an important aspect. The other thing we're not hearing a lot about yet, but I think a lot of us feel that there might be a tax bite coming along. Can you just speak for a little bit about the tax advantages of investing in farmland?
Well, the tax advantages, we have a couple different structures, and one structure we have is a corporate structure. In that structure, we do provide the opportunity for investors to have access to the small business capital gains tax exemption in Canada. And that's because we operate each corporate structure, which has a limitation of 49 investors, but we operate each of those structures as it falls into the qualification of a small business. And that's why the capital gains tax exemption is in play. So an investor who has a capital gain would be subject to that capital gains tax exemption up to about $870,000. So it's a very nice added bonus, if you will. I wouldn't be coming to invest just for that reason. I mean, you shouldn't be invested in farmland for other reasons, but that is a nice added feature that we have.
Well, as an accountant, I had to ask that tax question, Kent.
Yeah, of course. Yeah.
Now, we've got a bit of a wet day out there, but we had a nice tour, Bob and I, when it was drier, and we have a farmland tour set up for our clients, some of the CPAs who we work with, and other investors on June the 7th, down near the shores of Lake Erie. So why should a potential investor join us for this tour, Kent, other than the nice bus ride and your wild driving?
Well, I think a lot like what David said. I mean, if you could actually come and see what we do, because we do a lot of similar things. I look for farms that are problematic and have problems and issues that we need to fix, and we improve the value, and we optimize, and then we make them more productive, and we focus on the soil health. And it's very difficult to sit here on a Zoom call and explain all these things, but when you come on the tour, we can show you exactly, like, this is a farm before it's fixed up, and this is a farm that's after it's fixed up. So very similar sort of a thesis to what David is doing with the residential properties. We purposely look for farms that are not perfectly optimized. And there's a lot of farms that are not perfectly optimized because 50% of the people in the province of Ontario that own farmland don't actually farm the land, because the small farmer has been pushed out of farming, but they still own the asset and they rent it to other farmers. So neither one of those people are incentivized to improve that asset. Whereas we come in, that's what we're focused on. So it's fun to buy beat up farms, if you will, and fix them up and make them more productive.
Thank you. I really encourage people to seriously consider that June 7th due diligence trip. I learned a lot about farming, and like you say, it was very hands-on. So thank you very much for joining us this evening. Bob, back to you.
Thanks, Paul. And unlike Paul, I did grow up on a farm, and one thing I was impressed with was the quality of the soil on the farms down by Lake Erie. It's pretty impressive, the topsoil. Next on the agenda is John Hutchinson. He's Global Head of Origination for Trez Capital. In his role, he's responsible for overseeing the company's commercial real estate lending and equity development businesses across North America. Trez is involved in developing real estate trends such as build to rent, that, you know, some of the emerging things that are happening that people haven't really heard of before, to help find suitable housing for their growing families. Now, Stewards has been working with Trez for 10 years now, and we're excited to have John join us today. So John, first question for you. Each of our panelists is quite unique, but the focus is on helping investors to make money in real estate. Now, you heard you and Dave have known each other for a long time, and you've heard his comments about Western Wealth and how it's focused on opportunities in multifamily in hot job markets across the US that were built in the 70s and 80s, and then applying their value add to these properties. And then you heard Kent talk about farmland in Southwestern Ontario. Now, in a nutshell, can you explain some of the focuses, because I know that you're broadly focused in the opportunities that you're identifying for investors?
Sure. Thank you, Bob. Thank you, Paul, for having me as part of your program. As many people know, Trez is a lender. About 7 years ago, we expanded into providing equity as well into projects throughout the United States. Our primary focus is in residential property. We finance and invest in lot development, where communities of lots are developed and then sold to home builders that build neighborhoods. We provide financing and equity into multifamily construction, a little bit of value add like Dave does, but mostly new construction. And we also are invested in self-storage, which we consider a first cousin of residential. When you have great growth, people need places to store. And in most places in the United States, most new homes are not built with basements or attics for that matter. So there's no real place to store in the homes. And then there's this build to rent asset, which I'll get into in a few minutes. So we provide debt and we provide equity, and we do so throughout the South, the Southeast, the Southwest. We have offices throughout the country. We have boots on the ground in various places so that we can get familiar with the markets. There is a significant undersupply of homes in the United States, both single family and multifamily, due to various factors, increase in household formation. The millennials have finally started to buy houses. Some data shows that we may need 17 million new homes over the next 10 years. And from 2011 to 2020, we only produced 7 million. There are fewer housing starts. I'll give you some statistics. There are fewer housing starts in the United States last year than there were in 1960. And we now have about 130 million more people in the United States than we did back then. So there's been a tremendous undersupply, and it is, as Dave said, it's going to be very hard to overcome the situation because there's a shortage of materials and there's a shortage of labor. So it is, I never thought I'd see the day when I was in the home building business for 15 years. I never thought I'd see the day when home builders would stop selling homes. But home builders throughout the United States and the high growth cities are putting limitations on how many homes they'll sell. They're putting limitations on when they'll sell a home, and often cases they won't sell a home until it's nearly complete because of problems with costs. And houses are taking longer to build. Houses that used to take 90 to 120 days are now taking 180 days or more to build. So there's a vast undersupply, not only of single family, but of multifamily. And that exists throughout the United States in the high growth cities. And there's really no sign of it changing anytime soon. So that opportunity that Dave discussed with the value add product and what we do in more new construction, we expect to have that opportunity for many years to come.
John, in a presentation like this, I think we could probably go on and talk about the 88 million millennials that, there just aren't enough places for them to live. But can you just talk, go a little deeper maybe on population trends that you're seeing taking
Sure.
place south of the border, and maybe
Sure. In the United States, there's what I call a great migration going on. Let me just give you a couple statistics. From 2010 to 2020, 750,000 people moved into Dallas-Fort Worth from other parts of the world or the country. Houston, 640,000 people. Phoenix, 601,000 people. And all these high growth cities, descending number. The biggest move was into Dallas-Fort Worth. Second was into Houston. Third into Phoenix. But by comparison, New York City lost 778,000 people. Chicago, 518,000. Los Angeles, 512,000. Those people are moving into cities and cities that are in states that have no tax or very low tax, and have a more affordable, situation for housing and other things. I mean, David mentioned some of the high tech companies that are moving into Phoenix and moving into Dallas, moving into Austin. I read an article today. Dallas employs more high tech people than any other city in the country. I was surprised by that. But it's a big city we're the fourth largest metropolitan area in the country. So it's people are leaving, and they're voting with their feet, and they're going to other cities and other states, and that is a great opportunity for us to take advantage of that. As David's doing with value add, we're doing more with new construction, and the numbers are nothing but astounding. I mean, we've had about 200,000 new jobs created in Dallas in the last year. We now have more people employed in Dallas-Fort Worth than we did before the pandemic. And that's because people are moving their companies there, and people are moving to get jobs in those companies that are moving. In Phoenix and Dallas and Austin, I subscribe to various newspapers, and it's very seldom do you pick up the newspaper and not read about some company moving or expanding in those cities. And you can say the same thing about Florida. Florida attracts a lot of people from the Northeast, whereas Phoenix, Dallas, and Utah, they attract people from more from California. But it is a tremendous opportunity in the United States to take advantage of this. Let me give you something else that I think that the listeners would find interesting. Projected population growth from 2021 to 2026 in the United States is projected to grow by 3.6%. Texas is projected to grow by 8% in population. Arizona, 7%. California, only 2.6%. And in fact, California lost population last year. Colorado, 7%. Utah, 9%. All of these states that we do business in are far exceeding the United States growth populations. And along with that growth comes jobs. Jobs are driving the growth. So it's a tremendous opportunity, we feel, particularly in residential. We don't participate very much in office or retail. There's obviously issues there with Amazon and the pandemic and people working from home, which the people working from home has created an opportunity for residential. More kind of explosive growth in the suburbs for residential needs.
Now, Dave Steele talked a bit about improving existing properties, but just touch on a couple of trends I've heard you talk about when we had lunch back during COVID heavy times there, just after they lifted it.
The nature of the rental business in the United States has changed. I mean, there's always been garden apartments and there's always been high-rise apartments in urban areas. There was never a national, kind of a national landlord. After the recession in 2009, 2010, banks had hundreds of thousands of homes they had foreclosed on. Wall Street formed groups to buy those houses. So they proved up the institutional nature of this. They managed tens of thousands of houses. Some of those companies have since gone public. But what they found was that they're difficult to manage. They're inefficient. When you have property spread throughout a city, it's difficult to manage. So what's happening now, and we're participating in this in one of the funds we manage, there's this build to rent aspect where entire neighborhoods of homes are built for the purpose of renting them. And land is bought, 30, 40 acres of land in a large master plan community. You buy the land, you develop the lots, you have the homes built, and you rent them out. Though it's very popular for many reasons. One is you have people moving into these metropolitan areas that may not be ready to buy a home. They want to test out the area that they may live in, or the schools that their kids may go to, but it's part of a large master plan community. So if they decide they want to buy a home, there'll be homes in that master plan community they can buy when they're ready to make that decision, and they won't have to move into another school district. They won't have to displace their kids and whatnot. So you've got this build to rent, entire communities being developed and then rented, and then ultimately sold to these big funds, and the returns are astronomical. Then you have this other asset which started in Tucson by a company by the name of Next Metro, and then we started financing them when they moved to Phoenix. We've done 25 loans with them. They build a multifamily product that is unique. I mean, there's others now that are copying them. It's single-story multifamily. They're small cottages, for example. They're the one-bedroom apartments will be a duplex. The two-bedroom apartments are totally detached, and the three-bedroom apartments are totally detached. So you don't have anybody living above you, don't have anybody below you. You have little backyards, you have little porches, you have places to park. There's some amenities. They're not intended to be sold individually. They're intended to be sold as an entire complex. They're not on platted lots like your normal single-family house would be. Tremendously popular. Phoenix is the hotbed for them. But we've financed Next Metro across the country. They're now in Denver, Dallas, Austin, Florida, Atlanta, and there's others that are now doing that. And I wouldn't be surprised if you see it turn up in Canada, and it's going throughout the United States. So that's a different build to rent than the houses that are on platted lots. It's part of a bigger community or an individual neighborhood. So it's a very, very popular asset. Typically, the rents in that kind of project get about 15% above what you can get with a garden apartment, and they're very popular. And the popularity is spreading all over the place.
Yeah, so John, you've shared with us a number of opportunities. Now, there are people who are interested in investing in real estate, but they don't want to particularly be a landlord,
right?
And get a call in the middle of the night to fix a toilet or whatever. Through your firm, what are some ways that people can invest in these hot opportunities in the real estate market?
Well, as I said, we have funds that loan to these developers that do this, and then we have funds particularly one that we're starting up now that has invested in multifamily construction, build to rent, where we're going to buy land and develop lots and develop homes, and we've got self-storage and we've got lot development. We've got projects throughout Texas and in Arizona and in Colorado and in Atlanta, and it's a program that people can invest in, and there'll be distributions and there'll be growth, and there'll be an opportunity to provide to participate in the growth of these cities over in the future. We had funds in the past that were limited duration funds, and they've done very well, but they were basically build to sell industrial or build to sell apartments. The intention here is we can hold on to assets for a longer period of time if we feel that that's the best course for the investors. We can sell them or we can hold on to them. We don't have a limited duration like we did in the other funds. In the United States, there's great tax advantages to multifamily. Ultimately, if you hold it for a year after it's finished, you can get a long-term capital gain. I'm not trying to be tax attorney or lawyer for anybody, accountant in Canada, but properties can be refinanced without incurring any tax. Money can be distributed from refinancings, and we want to take advantage of all of those things in the funds that we have for equity. But so we have both debt and equity. Depends on what where you want to be on the capital stack. Yeah,
and with markets acting the way they have been, and testing investors' resolve. I know that many of the concepts that we've invested, it's a little easier for investors. It's a longer time frame, but you don't have to watch the price go up and down every day. It's a more stable long-term investment. So you do have a bit of a lockup, but it has many advantages for longer-term investors. So just as we're kind of dead on time, I'm just going to throw one final thought before I turn it back to Paul. And that is, remember that we do have the Q&A section open. We will be addressing your questions at the end. If you have some, just post them and we'll deal with it. But now back over to you, Paul.
Thanks, Bob. Now we're going to switch gears quite dramatically, because we're moving from really tangible real estate. And I want to introduce David Harris Kolada. He's managing partner at Green Soil PropTech Ventures. He's an accomplished financier and entrepreneur. Dave brings to Green Soil a proven track record in venture capital, investing in PropTech, IT, and clean tech. He served as a senior business advisor and executive in several high-growth tech companies. And in the last couple of years, he's joined Green Soil. It's interesting that when we think of real estate, it's such a significant asset. And we're also hearing about the need to be mindful of our environment, and the idea that some of the tech is probably 2/3 of that is dedicated towards carbon reduction. Dave, welcome this evening.
Thanks, Paul. Great to be here.
Yeah. First question. When we think of venture capital and we think of real estate, how does PropTech relate to the venture capital market? And just talk a little bit about, we're going to talk about carbon reduction later on, but you can just give a couple of examples about property technology and how it's applicable to people's current holdings.
Sure. Yeah, thanks for the question, and thanks again for being here. And I feel a little bit like the one thing that doesn't look like the others, but there is a really strong connection. And I was really, I'm happy to be batting cleanup as well, because there's some really interesting comments that were made earlier that we hear regularly in our work, because at Green Soil, we're domain experts in real estate, and we're long-standing venture capitalists. So we bring both of those things together. And I think that's one of the reasons that makes us successful. And to your point about, how does venture capital relate to real estate? And, one of the things that I think is important to note is that venture capital has traditionally been a very sort of cottage industry, small funds, people that invest close to them geographically, and would invest in anything that's sort of tech related, not very specialized. The last 10 years in particular, the venture industry has become much more specialized. And one of the things in particular around that is industry specialization. And real estate, as everyone I think on the panel today would attest, is a unique vertical. It's a unique industry. It's got attributes to it that are very different from any other industry. And so we believe as venture capitalists that we have to be really smart in how we invest in technology that goes into that industry. And so, we were one of the first industry specific funds that started back in 2015, and we're now on our second fund. We've been quite successful in those years. And you asked about some examples. So let me share two with you, one that we've already invested in and one that we're looking at, to give you sort of a real life example. So one is a company that we invested in last year. I'm on the board of the company. It's a company called Wind with a Y. And it's an indoor air quality technology, which is obviously very topical with the pandemic. People are much more aware of their air quality than they ever have been before in their lives. Although it's not just viruses, it's also things like wildfires in the West and those kinds of things. Or if you're renting out apartments or you're a hotel, air quality in terms of smoke, and knowing, is it cigarette smoke? Is it from a vape pen? Is it some other kind of a smoke? And so what Wind does is they allow you to actually detect exactly what that is through sensing the particulate matter, microscopic particles that are in the air. So they can tell you what it is based on its shape and size. But what's really interesting from our perspective is that they can actually do something about it. So their technology integrates with the HVAC systems, the heating, ventilation, and air conditioning systems, to then remediate or clean the air as it's needed to be able to get to a set point. So if you think about temperature now, you turn your temperature up and down if you're hot or cold. So what they're allowing you to do is to be able to have an indoor air quality set point and to give you the assurance and all those occupants of the space that your air is of sufficient quality. And the environmental side of it is by being able to zone it and know what the air quality is like in a particular part of a building, they'll only bring in more fresh air and remediate the air in the areas where it needs it, as opposed to the current approach, which is just pump lots of fresh air into the building so that you get to the air quality you're looking for. But you might have great air quality in one part of the building and very poor in another. And bringing fresh air into a building is very energy intensive. So that's one of the things we really like about wind, is this ability to use technology to both solve a problem, give assurance and comfort to those that are occupying it, and also save energy. So that's an example of one that we've already invested in. They're doing very well. And the second one is a new one that we're just looking at now. We haven't actually secured the opportunity to invest in them yet, so I won't give you their name, but it's a pure software company. And what they're doing is they're allowing multifamily residential building owners to, it's an enabling technology for them to put solar panels on the roof, which you may wonder, well, what's so complicated about that? Well, there's sort of an agency or a split incentive issue, because most occupants of multi-unit residential buildings pay their utility bills directly to the utility. So if you're a building owner and you put solar panels on the roof, unless you can get the occupants to sign up and participate, you're really only able to use that energy to heat and cool public spaces, and, garages, hallways, etc. So what this allows them to do is to provide the occupants with guaranteed savings on their energy bill through the software package, and then allow the building owner to save, to create a new revenue stream, because now the occupants are paying the building owner for their energy, which is generated cleanly through solar panels. And then of course optimize with the grid, because at some point they'll have to use energy from the grid as well. So it's really at its core a building solution, which is not that complicated, but it's the domain expertise and the understanding of how to navigate the particular relationship between the occupants, the renters, and the landowners, but also the utilities, which makes this really interesting, why it's a prop tech solution. So those are two examples of interesting technologies that we're invested in and are looking at right now.
Thanks, Dave. And I think that really gives us an idea of what's out there. Now, the focus of this roundtable is largely about trends and opportunities. And when we think about technology for real estate, what are some of the longer term trends that you foresee and technology being a solution?
Yeah, there's really three big trends that we're benefiting from as prop tech venture investors. The first is the real estate's going digital. It's an inexorable trend that's now in sort of the mass adoption phase. And this is huge news, because the real estate industry, no offense to my fellow panelists, doesn't have a great reputation for adopting innovation and very quickly, tends to be a laggard. The benefit is that that's actually now changing. And the pandemic has actually been a really big catalyst for that, because it's forced real estate companies to be able to operate at skill and precision from wherever, however, in a rapidly changing environment. And so what a trend we saw, 8-9 years ago, has just been accelerating in terms of going digital and being able to do things remotely in the cloud, which is using the internet as opposed to things that are local. And so that digitization of a very large, it's the largest asset class on the planet. So when you think about a very tiny fraction of real estate being digitized today, even a 5 or 10% increase over the next 5 years would generate massive amounts, billions and billions and billions of adoption of new technologies, just because of the scope and the size of the industry. The second is demographics, and we heard about this earlier. The millennials are a huge force in our economy, generally speaking, but in real estate, it's also massive. And it's relevant in two ways. The first is the generational change that's going on in the real estate companies themselves, something that isn't talked about a lot. Real estate's very much family owned, although of course there is more institutional ownership, more than ever, but it's still a small piece of it. The vast majority is owned by families. And the older generation is passing along the ownership of their real estate companies to the next generation, who are saying, we do everything on this. And this has the computing power of the computers that sent the space shuttle to the moon in 1969. So, and they expect everything to be easy, to be able to dab and swipe and pinch and, and get things done very easily. So they're saying, the way we're currently running the real estate business is not sufficient, needs to change. So that's driving adoption of new technologies. And the second is the actual consumers, the occupants, those that are renting real estate, buying real estate. They're not satisfied with anything other than something that's aligned with their values. And their values are user experience has to be great. And secondly, it's got to be sustainable because they care about the planet much more than our generation does in the previous generation. For them, it's mandatory and essential. So that's driving adoption of technologies. And the third thing is, as I just alluded to, is climate change. And really, it's a climate crisis. 40% of global energy emissions comes from buildings, 40%. So if we're going to try to become carbon net zero, meaning that we emit, we save as much as we emit in carbon emissions every year, or as we like to say, a green soil, a climate neutral economy, the only way we can get there is by addressing the built environment and real estate. So when you look at those things, those are the really big trends that we think are driving our industry. And what's really exciting about that, Paul, is that it gives us the most important attribute to an investor in a technology business, which is the technologies are demand driven. It's not technologies that are trying to find a solution, a problem to solve. There's demand that's there, and they're providing solutions that are going into that demand. And that's sort of like a rising tide that raises almost all boats, but you still have to back great management teams and differentiated technology solutions. But without those demand characteristics, it's very difficult to repeatably make money as an early stage technology investor.
So, Dave, I find it interesting that when we listen to our politicians, they've got the topic right, but I don't know that government is the best. In fact, I do know that government isn't the best at actually initiating the change. So it's often the actions of entrepreneurs. And one of the things it seems to me is that entrepreneurs really are at the forefront of this, more willing to adapt technology and so on. So could you just speak a little bit about how entrepreneurs are leading this charge in this change that's needed?
Absolutely. So the first is, and I don't want to repeat myself, so I'll just say the headline and then move on, which is, again, millennials. Demographics are just you can't get away from demographics. And millennials, the vast majority of the entrepreneurs that we're backing are millennials. That's the generation they come from. So, they're saying, and what's interesting about that is not only are they, digital natives, which we've talked about earlier. Secondly, the climate crisis is real to them. They will vote with their dollars and their jobs. So they will work at places where they can make an impact, or where they're not doing any harm to the environment or more than they need to. But also they're voting with their votes. So to your point about politicians, they're voting parties into power that are actually consistent with their values and will mobilize capital either through investments or the tax code to provide the opportunities necessary to bring these kinds of technologies to the forefront. So I think that's the first thing I would say is the entrepreneurs are millennials and they believe in this and they're actually doing something about it. They're not just talking about it. The second is, we're now in what we call PropTech 2.0 in our industry, which basically means it's the second generation of PropTech, which brings a number of things, including a lot more capital because people know it exists and more institutional money is moving into the space, which is great. It's helping us and others. But the other thing it's doing is we're now seeing second generation entrepreneurs or serial entrepreneurs in our space that have already built a PropTech company and exited it and made money for their investors. And they're going back and they're doing it again because they weren't satisfied with the first one and they want to make even more money and make a bigger impact. So we're benefiting from that as investors, and we're seeing some entrepreneurs that are benefiting from the technology infrastructure and innovations that have been funded through billions of dollars of investments in IT and internet investing over the years, and saying, I can use that fundamental technology, whether it's 5G wireless or the ubiquity of the cloud or the cost curve coming down on things like sensors or solar panels or whatever it might be, and use that and harness that to develop a solution, a use case we call it, that's relevant to real estate. Because again, they didn't start with real estate; they started with other sectors that were more earlier adopters. But now they're turning their eyes to this prize that is still relatively untapped. So that's another thing that we're seeing is these sort of second generation entrepreneurs. And then the third thing I would say is that, the entrepreneurs we're looking at are not just looking to create solutions that go into buildings, literally go into buildings, they're innovating in some adjacent areas. Things like, how do you finance it? So one of the things that we invest in, as well as classic prop tech, if I could call it that, things that go into buildings, is fintech, financial technology as it relates to real estate. The previous panelists talked about, build to own, or sorry, rent to own. There's some really interesting technologies leveraging the blockchain and other innovations that allow you to effectively own real estate without having to come up with the same kind of down payment in a traditional, lending model and down payment model. So we're interested in that. And other ways to sort of tackle the affordable housing issue, which is really, really a pressing issue, particularly in some large cities in North America and around the world. Mobility, how do you get to a building? How do you get home from a building? How much time do you spend in your commute? How much energy do you consume? How much emissions do you emit? Technologies allow you to optimize that, make the experience better for the tenants, the occupants, and help the environment. Those are some interesting new areas they're looking at. And also, how do you use the energy that's in the building or being used by the building in a more distributed manner? So it's actually a new asset to be able to monetize that. So those are some areas that people might not think of as classically real estate technology, but are the kinds of things that entrepreneurs are now turning their eyes to and that we're looking to invest in.
What strikes me from your comment is that when people traditionally thought of venture capital, this sounds a lot more conservative than traditional venture capital because of its application to something that's more traditional. So in the interest of time, I won't have you comment on that now. There may be some questions. I'm going to turn it back to Bob.
Okay, so back, as I mentioned before, if you can, if anyone has a question, you want to click the Q&A button on your Zoom control panel. We've got a couple things that are up here. Randall's probably been waiting since 7:13 for his question, which was, hello, Dave from Western Wealth. You mentioned a shortage of tradespeople. Do you face the same challenge, especially in the cities that you are involved in or that are foreign to? So are you seeing a problem with tradespeople, Dave, and are you on mute?
We definitely see a shortage of trades. The good news is we're not removing walls and we're not doing any major building or renovations. Most of what we do is fairly cosmetic, hardwood flooring, appliances, bath fixtures, that type of thing. So, we're able to do it pretty much with our own in-house crews in Texas, Arizona, Georgia, and Las Vegas. So big part of it is just being able to, retain our own people, but we're not really deep with a lot of trades like electricians, plumbers, framers, where there's a real shortage.
And now, when we first met, Dave, you were outsourcing the property management in many cases on the properties that you're involved in. That seems to be a major change at Western Wealth over the past 2 or 3 years.
Yeah, I mean, at the end of the day, we like to control everything from start to finish. And as David said about the technology, when we took over 2 years ago, 12% of our tenants paid their rent online. Today, we're pushing up against 80%. Now, if you think about that from an operational standpoint, that means 80% of the people have already paid their rent automatically out of their bank account by the first day. So, you're not running around at, 5 o'clock on the day chasing people for rent. You've got a much smaller number of people who come into the office and drop a check off, but the majority pay it online. So, there is no secret that the technology world of real estate is way behind the curve, and anything that can be done to improve the technology in real estate, we looked at it from our property management and said, these old legacy systems and these old legacy approaches that the property management companies were running with were just totally contrary to what we're trying to create. I totally concur with what David said about, and I'm also very interested to understand how the solar panel thing works.
Yeah, it was running through my head that as David was talking about that, the solar panels, that you started adding up the math that if you can bring that in-house and increase the value of the building, that you'd be all over that. So
number 84 on your list, or is it 83? I lost count.
That's right. Yeah. So I'm sure you guys will have a conversation. as you go. A comment from Ted where he said CBS 60 Minutes last week, there was a show called Rental Housing Shortage in the US. That was just more of a comment. And he also commented that he's looking forward to the Western Wealth Fall Tour because April 30th, April 29th wasn't probably the best day for accountants to move out of the city and visit another location. Now, we're not, as I mentioned earlier, don't be afraid to ask questions. There is no bad question, but let me try this, and I've done this in other panels that we've run before. That we have 4 panelists with us this evening who come from quite different areas. So it's. And Dave Steele, you brought up the idea about the panels, but, John, do you have a question related that you would like to ask our panelists tonight, or, anybody else, any of the panelists, ask the panelists a question?
I'd like to say something that about a month ago, I may have seen the future of home building. Home building is a very inefficient business. Statistically, 35% of the materials delivered to a site to build a home are thrown away. If you've ever gone out on a new construction site for homes, production homes, the trash is just unbelievable. And there's always an effort to build modular homes. I'm not talking about the mobile homes, the double wides or single wides. And then there's a company that's starting it up, and they're in Florida, and they're coming to Texas. And I saw what they were doing in Florida, and they're going to have factories that are going to build component bathrooms and kitchens, and these houses are going to be built in components. And if this can actually happen in a big way, they'll be able to reduce the cost of homes dramatically and increase the cycle time. So it's something to watch for in the U.S. and maybe happening in Canada, but it's the future of home building. It's just a matter of who does it.
We agree, John, and we decided to put a bucket in our fund specifically for modular construction. We're planning on investing in a basket of investments in that area because there's a variety of elements to it on the robotics side, on different approaches to it. There's a number of companies that are doing it. I'm not sure which one you're referring to. We probably looked at them. As a relatively small venture fund, we have to be selective because some of those kinds of companies will be relatively capital intensive and will need bigger investors that can write bigger checks. But yeah, there's some really interesting innovation going on in that area, and I totally agree with you.
The homes look like other homes. Now, they do have some limitations on what they can do architecturally, but I think you'll come to a time where modular homes will be your production homes, and custom built homes will be your high-end homes. It really has to happen. I mean, the waste, the inefficiency is just incredible.
Yeah, I read a stat the other day that construction is the only major industry that has lost productivity in the last 100 years.
Yeah. And there's an environmental aspect to it. I mean, you have so much waste filling up landfills and whatnot. It's just terrible. So it'll happen. It's just a question of who's going to do it. I always thought it was going to be Warren Buffett because he was buying. They've bought the companies that build mobile homes, so to speak, and other things. But I'm not sure they're going to do it.
I just wanted to bring up a point here relative to farming too. One of the things that struck me is that when we're down visiting these farms, and Kent is saying, well, one of the things we do is we go in and we tile the property. Okay. Now, that may not sound like a high-tech solution, but Kent, can you just sort of speak to those changes, those innovations that are being made to properties that you purchase, and what that does to the value of the land from a rental standpoint and a productivity point of view?
It all comes down to productivity gains. Like I said, we have to make more food on the same amount of land. So tiling, for example, improves productivity by 30%. So it's about a $1,500 per acre investment that lasts for 50 years. And we can double our rent immediately as a result of this tactics. So It's all based on productivity. And just listening to the panelists, one thing I wanted to sort of express to the audience about farmland is these investments in properties and the shortage of housing is incredible. One thing unique about farmland is that it's an asset class that has yet to be attacked, if you will, by the greater investment community. There's very few people investing in farmland, which makes it difficult as an investor to get involved with it. So that's one of the unique things is there's very few people doing what we do, and trying to make productivity gains in farmland is sort of a new thing, if you will.
And so Kent is, one of the things that we like to watch is institutional activity. Are some of the big pension plans, are they looking at farmland right now?
Yeah, and that's the problem is there's several institutions currently trying to deploy $1 billion. They literally said to me personally, we're trying to deploy $1 billion in farmland. But the problem is that farmland is owned 98% by farm families. 98% of it is owned by just families. So how do you deploy $1 billion into this asset? You have to do it $1-2 million at a time. And institutional investors just don't have time. They want to write a check for $100 million and be on their way. So our company is building portfolios of farmland that can one day be exited to a larger investor that wants to write this asset class because of the it's a very inefficient asset. It's broken up by farm by farm by farm. It was settled 50 acres at a time hundreds of years ago. That's how farmland was divvied up after the War of 1812.
Mm-hmm. Yes, we have a couple other questions from our guests this evening. Marco asked the question, any thoughts on leveraging analytics / AI to predict trends and to identify growth opportunities? For example, Zillow tried this.
Yeah, so I guess I'll take that one. Absolutely. So I took the guidance seriously, not to use a lot of jargon. So I didn't touch on this, but thank you for bringing the question up. So the company I mentioned at the outset, Wind, is doing this. They're using the data coming off their sensors in built spaces around air quality to do a couple of things. One is to predict when the air quality is going to get worse because of historical trends, whether it's a time of day or weather patterns, et cetera. They get data in from weather feeds, so they know what weather's coming, with the temperature change, external weather change, humidity, outdoor air quality, because of course that has an impact on indoor air quality. And then preventatively, and this is how the algorithms get smarter, triggering the HVAC system to bring more fresh air in and to improve the air quality before it starts getting bad. So that's something that's a real life example of how they're using analytics and AI to predict those trends. And I mean, generally speaking, the whole Internet of Things and IoT and using sensors to collect all this data is interesting, but it's still mostly around describing what has happened historically. So that's sort of the descriptive part of the value chain. That's not all that valuable to users yet. What's more valuable is the second part of the chain, which is being predictive, which you mentioned, like what's going to happen based on historical patterns. And then the next piece, which is still mostly in its infancy in terms of most applications, certainly in the real estate world, is getting prescriptive. So it's the computer now saying, not only can we tell you what's going to happen, but if you let me, I'll go ahead and take care of it without you intervening as a human. So that's sort of where things are going, but you have to build up a fairly large data set first so the machine can learn from it. And then you humans need to train the data, as they call it. So they manually intervene, looking at the patterns and say, okay, well, based on this, you should do this. So the computer gets smarter and smarter, the algorithm gets smarter, and then you can eventually get to that place where you can actually cede control to building automation systems, in our case, to the algorithms and let it do its thing without the need of human intervention to benefit things like air quality, but it could also be things like lighting or temperature control or elevators or security cameras or a variety of other things. And on the transportation side, we see it with traffic lights and a company based in Waterloo called MyoVision that's optimizing traffic light sequences because it knows the traffic patterns and knows how many cars are going to be coming, and it sequences the lights so you're not sitting there at a red light with no one coming the other direction. So there's all kinds of interesting applications that create a better experience for individuals, whether it's someone driving a car or someone occupying a building, but also saves money and ideally also saves the planet.
Okay, question from Fu for John. In the old Democrat-run cities like New York, Chicago, Detroit, are there opportunities for new housing?
Well, I think Detroit is actually coming back quite a bit. A lot of it with the electric car, movement with the Ford and GM. The problem is, I was on the airplane today with a lady from Chicago. She can't wait to move out of Chicago. She says that the parents of the children that are her children, they're going to graduate from high school. She said hundreds of them are going to leave Chicago. I'd have to advise one to be very careful about investing in some of these high tax cities. It's not just the tax. There's other things. The crime in some of these cities and the failure to enforce laws is a big problem. And it's, every weekend, dozens of people are shot in Chicago and it doesn't stop. And, things are happening in New York now. New York is regressing back to what it was in the 70s in terms of safety. And so people don't want to be there and they're leaving. I'd have to advise people. We don't do, it would have to be a spectacular opportunity for us to put any money in Chicago because of the loss of population and everything else going on up there. But Detroit, I do think is a bright spot in terms of opportunities because of the job growth around the EV movement.
Mm-hmm. Okay, now just to wrap things up, I like to end it in a certain way, but I'm going to deviate from that a little bit. Dave Steele, we've been investing client assets with you since around June of 2019. What, for those investors who've been around for a year or two, what might they see, because we're approaching that 3-year number that you talked about? Are there some things that we might see this year for those investors?
Yeah, we're actually going to have quite a few exits this year. A lot of the deals have hit their 3-year threshold numbers that are very, very good. Our only reluctance to sell some of these is that, we're going to see big inflation in the US. I mean, if we saw another year of 10% rent growth in the markets we're in, I wouldn't be the least bit surprised. And, much like everyone on this panel, I think food, oil, real estate, and ammunition are probably 4 great places to put your money, right? Oil, I feel like I wish I had poured my money into oil 6 months ago. Not sure at today's prices I'm going to come in. Food, I think as one of the panelists who's in it is saying, I totally agree, but I think the general outlook for food has got to be very, very good with what's going on in the world. And I think we saw call it 1 million people leave Syria, and we saw the ripple effect of those people. We had 400,000 immigrants coming to Canada this year. What does that look like if we get 1 million or 2 million immigrants coming to Canada, and then extrapolate that to the US with what's going on in Europe? So, I think we could see some very, very large in-migration numbers. I don't think there's any way around it. We're going to see big inflation, and that's going to have a big effect. So, I think generally the sectors that everybody's here, I think there's a reason why Wealth Stewards is kind of taking the forefront for these type of product. I think the outlook we all see is it's a very, very good outlook, I think, for the next several years.
Right. So as a final thought, anybody interested in seeing these, we'd be happy to have you join us for the tour down in Dallas at the end of April 29th, right?
You bet.
Yeah. Kent, final thoughts?
Well, it was interesting. We were just talking about the Ukraine and different parts of the world. I mean, I think we're pretty fortunate here in North America. I think there's a lot of attraction to our real estate, to our farmland. to the way we live our lives. And we're fortunate to have the opportunity to invest in these alternative assets. All these speakers have great opportunities. And again, thanks to Well Stewards for recognizing and yourselves doing a diligence into all of us and potentially bringing these opportunities to your clients. So thanks again for that.
Okay, John, final thoughts?
Just reiterate what I said earlier. There's a massive movement of people in the United States, of jobs and population, and we don't think it's going to end anytime soon, and that presents opportunities, particularly in the residential area. And we provide both debt and equity into the residential space, and we'll continue to do so.
Perfect, thank you. And David, final thoughts?
Never waste a crisis. We have a climate crisis. We have an affordable housing crisis. We have an immigration, soon to have an immigration movement of people crisis, not just the one in the US that was mentioned, but also in Europe with, of course, the awful displacement of people in Ukraine and beyond. And I think, as Kent said, that we have opportunities here to with alternative assets and investments to take advantage of the significant changes that result from that, to both make an impact and to make great returns.
Okay, well, and thank you to all of our panelists this evening. I love this format. I think it's, we just try to make it a fireside chat, and I think people can learn from that. So with that said, I'd like to turn over to Paul Tyers to close.
Well, I just wanted to say thank you again to everybody. We appreciate the time people have taken to actually join us this evening. I think some excellent insights here. And one of the things, Dave, you alluded to is the idea of looking at alternatives. It only takes the last 3 months to reinforce the fact that public markets can be quite volatile. And I think these are times where the alternatives have provided some of the stability that people like to see. We do a lot of these webinars, some live like tonight, and some are actually recorded and posted in our due diligence library. We believe that although many of you some of you want to manage your own portfolios and do your own financial planning, while others want to hear directly from portfolio managers, such as we've heard here, and the different ideas about what's possible. I don't think too many people would have run into some of these ideas. Let's say if you're dealing with a bank-owned investment firm, because they take a while to get on the shelf, as it were. I just want to reiterate the fact that there are some due diligence tours coming up. Each of you all of the participants this evening will be sent a recording of tonight. And we hope you join us again for one of these. And thanks again for everybody this evening.